Hi, my name is Roger Schlitter. This video is actually about federal tax mistakes that can get you audited. And I know tax time is a little bit away, but it's coming up pretty quick. December's around the corner as I'm doing this video late November. So December's coming up quick, and then tax season is really from, anywhere from January through April. So anyway, while not all mistakes on your federal tax return will automatically trigger an audit, certain errors may increase the likelihood of scrutiny from the Internal Revenue Service, the IRS. Here are some common mistakes that could potentially lead to an audit. The first one of these would be math errors. You'd be surprised how easy these can happen. Now, I know they don't happen as much when you use TurboTax or something like that, but a lot of times, even with TurboTax, when you're doing the business part, you are adding up numbers and everything. And you definitely want to use the absolute number. You don't want to round off. Just use the absolute number, whatever you get. But simple math mistakes can occur when calculating income, deductions, or credits. So you really need to double check your calculations to avoid errors. And that is one of the biggest problems is math errors that the IRS looks at and says, hey, we want to look at this further. Number two would be failure to report income. And I know sometimes this is not intentional. This can be very unintentional. This can be one of those things where somebody doesn't send you a 1099 and you forget, you knew you did work for them, you got the money, but you kind of forget to put it on the, on your list of things because maybe you didn't get a 1099, maybe something got lost in the mail. So anyway, whenever you do work and you get a 1099, they also send that to the IRS. So if you are ever omitting something where the other party sent that into the IRS saying, hey, I paid this guy money, then that can also draw more attention to your file, to your tax return. So anyway, failure to report income, omitting sources of income, whether intentional or not, is a common reason for audits. Ensure that you report all income, including freelance income, rental income, and investment gains. Those are all things that sometimes people sometimes just omit, the whole thing, especially like investment gains and stuff. You really have to if you had some stock and you sold it and you made a big gain on it, but you might not remember to put that on your tax return. So anyway, the third thing would be incorrect filing status. Choosing the wrong filing status can lead to tax errors in the calculation. Make sure to select the appropriate status for your situation, whether that be single, married, filing jointly, head of household. Now, I know a lot of people that have a child or more sometimes do the head of household. Well, I think you can only use that once. You can't, both husband and wife, if they're not living together, or even if they are living together, cannot use head of household. I think only one of them can. So anyway, be careful on that one. Excessive deductions. And I know everybody tells you claim everything that you're supposed to get. Claim all the things that you need that you think you're eligible for. And sometimes these can get kind of carried away with these things. Almost anybody can, because these are taken off of your, the more you take off, the more income goes up. So anyway, excessive deductions, claiming deductions, that are usually high for your income level or that are not supported by the proper documentation can raise suspicion. So be sure to keep a thorough records. And like basically when you increase your deductions, you're actually decreasing your income, but it's income for you because these deductions are taken off of your the amount you have to pay, so you're going to pay less taxes on it altogether. Number 5 would be your home office deduction, and home office deduction has always been kind of a red flag for the IRS. They've done it for a number of years, and while legitimate, for those who qualify, the home office deduction is often scrutinized. It is often scrutinized by the IRS because they think everybody is, I had a guy once, believe it or not, I was in a bank and he came in for a loan and I was looking at his stuff and he had this office in the home, which was basically the whole home. he was writing off his entire mortgage and everything else. And I'm like, you can't do that. And he's like, well, yeah, I can. I use the whole home for my office. And I'm saying, no, you can't. You can only use the area you use. You can't use your living area. And of course, we didn't do a loan for him, but I don't think he ever got caught. Eventually, he sold the business to somebody else, and I did some loans with that individual. But I thought it was kind of funny how he I guess got away with it. I mean, I never heard anything. He never came and told me that he did, but I never heard anything really negative, coming from him or anybody else that knew him. So anyway, I guess you can get away with it. But anyway, you want to make sure you meet that criteria and that you can substantiate your claim with accurate records. That's the most important thing. Business expenses, number 6. Excessive or unsubstantiated business expenses can always attract attention. Keep detailed records of business-related expenses and only claim those that are necessary and reasonable. And if they are, and if they seem large anyway, if they're legitimate, you want to go ahead and claim them. You still may get scrutiny from the IRS, but you want to get everything that you're supposed to get, all the deductions and everything that you should get. Number 7 would be charitable deductions. If you have very large charitable deductions relative to your income, this can be a red flag. So you want to make sure you keep receipts for all your charitable contributions, especially for non-cash donations and cash donations. I mean, if you're given $20-50 at church every week, or you're given, you're dropping $20 every time you go by the, one of the kettles that one of the other ones has, one of the other deductions, or one of the other charitable organizations has. You definitely want to make sure you count all that up, and you can exaggerate. I mean, you can aggregate it into one, but it's really better if you kind of itemize it. What dates and everything that you give your charity. And like I said, really large things can really draw attention by the IRS, and really large non-cash donations. So be careful with those. Number 8 would be inconsistent information. Ensure that the information on your tax return is consistent with other documents, such as W-2s, 1099s. Inconsistencies can trigger an audit, and inconsistencies, the IRS, when you get a W-2 or a 1099, the IRS gets that information also. So they know that it exists. So, if you forget to write it down or something, or forget to use that part of it as income, that can be a big problem. But, and nowadays, I think, the IRS, as of 2022, and I think it goes into, and in the future, the IRS got a lot more money to hire a lot more individuals. Now, they always say, oh, they're going after the big guys. They're going after the guys that make $500,000 a year. Well, I'm sorry, but the ones, the low fruit is basically people that have self-employment income, people that have a Schedule C, people that have a home office. I mean, these people are low-lying fruit for the IRS. And these people usually, if they do the taxes themselves, then they risk, just doing it wrong. But even if you do have a person doing it for you, I mean, you usually kind of tell them what to put on it. I mean, it's not them. They're using your information that comes from you. So anyway, you want to be careful with all that. Self-employment income. Self-employed individuals may be more likely to face audits due to the potential for underreporting income or inflating business expenses. So you really want to keep accurate records of your self-employment activities, especially the expenses. You want to have receipts for all that. You want to make sure you do. And then also, your income. I know there is a I forget whether it's $400 or something. If it's that or below, I don't think you got to report it. So anyway, there is a lot of times when people don't report small amounts they have. The IRS, if you have a cash business and you're taking out cash all the time and not reporting it, the IRS does look at some of these cash industries and looks at all the tax returns they get, and they have certain benchmarks that they know these companies do. And they a lot of times will aggregate these benchmarks just by computer when they run when you enter your tax return. and they'll on it by computer they can kind of tell, whoa, wait a minute, this guy should be generating a lot more cash than he's reporting. So therefore, we're going to look at it a little more closer. By looking at it closer, they can send you a letter, they can do a full-blown audit. But just because you're a cash business, you still need to be careful, because the IRS knows how much most of these cash businesses should make, just because of all the tax returns they do for all those businesses. And the IRS, there's one thing they don't like. It's people that underreport income. It drives them crazy. So anyway, they will have a lot more agents from 2022 on. So I would be very careful, in doing this, because, they say they're going after the big guys, but let's face it, the little guys are easier to catch. They're usually not as sophisticated. So anyway, I'm pretty sure that the IRS is going to audit a lot more smaller tax returns, a lot more than they have in the past. So anyway, the 10th one would be cryptocurrency transactions. And I know a lot of people, are pretty loose with these, but the IRS has increased its focus on cryptocurrency transactions. Failure to report, any income from virtual currency or to properly report transactions may result in an audit. Number 11 would be foreign bank accounts. And I think in most tax returns, they ask you if you have any foreign bank accounts. Failure to report foreign bank accounts or income from overseas may lead to audits. And, as the IRS is very vigilant about identifying offshore tax evasion, so they're very careful about that. So, and that is one of those things you want to be careful about. But you have to make some money to be doing stuff overseas, I would think. So anyway, the little guys don't really have to worry about that. But some, people that are doing some business, sometimes they think they can get away with stuff, and I would be very careful. It's important to note that honest mistakes can happen, and they're not all errors are going to result in an audit. However, taking the time to ensure that the accuracy of your tax return and keeping thorough documentation can help reduce the risk of facing an audit. If you have concerns or questions, seeking advice from a tax professional is recommended. I know I usually do my own taxes, so I can't say too much about that, but I will look up stuff if I don't know it. So anyway, and I don't do anybody else's taxes, I just do my own. So anyway, so you can do your own taxes, but you do have to do some research. And tax professionals, usually they can guarantee that it is right, or at least I think they're licensed, and a lot of times they have insurance to cover if they make a mistake. So anyway, please subscribe and hit the bell icon for future videos, and also hit the like button, the thumbs up button, if you learned anything from the video. Anyway, my name is Roger Schleter, and I will definitely see you in the next video. Thanks a lot.